Welcome to another deep dive. Today we are really trying to cut through the noise surrounding Alibaba Group.
Yeah, figuring out what's actually happening with them. We're looking at their recent performance, how they kind of stack up in this whole e-commerce and tech world in 2025.
Right. And for this, our source material is, well, it's a mix. We've got recent articles looking at the competition, Alibaba's rivals, but also, crucially, their own latest updates, their financial results announcements.
Exactly. We're digging into their Q4 and full fiscal year 2025 results that just wrapped up March 31st.
So the mission today is, I guess, to unpack the key trends shaping things, zero in on who's really challenging Alibaba, and then get into those financials.
Yeah, understand what those numbers mean for you right now. Let's get you well-informed, fast.
Okay, let's unpack it then. The first thing, and our sources really hammer this home, is that e-commerce isn't standing still. Not at all. It's changing, like, incredibly quickly.
Oh, absolutely. And, a huge driver is still mobile shopping. It just dominates. Everyone's buying on their phones. And that changes everything, the experience, how companies need to, well, connect.
And tech's right at the center of that connection, isn't it? AI, for example. It's getting integrated everywhere. Sources mention tools like Alibaba's own Quanzhan Tui.
Right. And that's not just background stuff. It's actively personalizing the shopping experience and, maybe more importantly for sellers, boosting their visibility, getting seen.
Yeah, visibility is key. Then there's social commerce. That's another massive piece.
Huge. Platforms like Douyin, they're kind of blurring the lines, right, between just browsing social media and actually shopping. Live streaming especially, it's this direct, engaging way to sell.
Cross-border e-commerce just keeps growing, opening up markets everywhere. But here's what I found interesting, this trend towards nearshoring supply chains.
Yeah, moving them closer, especially towards Europe, apparently. It seems like a reaction to, well, all the disruptions we've seen lately. The companies want, easier communication, lower shipping costs, maybe just more reliability.
Makes sense. So with all this change, who are the main players really pushing against Alibaba?
Well, the sources point to a few key ones you need to watch. Obviously, there's Amazon, the U.S. giant, massive logistics, huge range of products.
The everything store.
Kind of, but one source did point out, while they have quantity, the quality control can be a bit varied, especially compared to platforms that really focus on vetting suppliers carefully.
Okay. And closer to home for Alibaba in China.
JD.com, that's their biggest B2C rival there. And they really sort of hang their hat on quality. Quality assurance, authentic sourcing, that's their thing. Plus, they've poured money into tech for super efficient logistics.
Right. That quality focus is central to their brand.
Definitely. Then there's global sources. It's highlighted as a major sourcing platform, particularly for, big box retailers.
Them specifically.
It seems to be their vetting process. It's stricter. They focus on higher quality, verified manufacturers. So instead of just the vast quantity you might find elsewhere, they prioritize that trust, especially for bigger buyers.
Got it. And it's not just the giants, right? There are others making waves.
Yeah. Emerging players in specific niches, DHgate, for example, they're really focused on small businesses.
How so?
Flexible ordering, low minimums, sometimes no minimum order quantity at all. That makes it way easier for smaller buyers. And Made in China is another one, known for directly connecting international buyers with verified suppliers pretty efficiently.
Yeah, and it's interesting. Even within Alibaba itself, you've got different platforms that almost feel like competitors.
Totally. Taobao is huge for local Chinese consumers, super price competitive.
Yeah.
Then AliExpress targets global shoppers, again, with that no minimum order thing, making it accessible.
So understanding this whole field, the giants, the specialists, even the internal dynamics, it's really crucial for you, the listener, whether you're strategizing, sourcing, or just trying to follow the tech world.
Absolutely. It helps you see the pressure points, how different companies are trying to win.
Okay, so let's shift gears now. From the competition to how Alibaba itself is actually doing. Let's look at their latest results, Q4, and the full fiscal year ending March 31st, 2025. What do the numbers?
Top line revenue, RMB 996.3 billion. That's about what, US $137.3 billion. A solid 6% increase year over year.
Okay, 6% growth.
Yeah.
But the profitability story seems more dramatic.
Yeah, income from operations jumped quite a bit more, up 24%. That's RMB 140.9 billion or US $19.4 billion. And the report says that big leap came mainly from reduced impairment charges and less share-based compensation. Plus, higher adjusted EBITDA. So yeah, better efficiency in turning revenue into operating profit.
And the bottom line, net income.
That was up a huge 77% year over year. RMB 126 billion or US $17.36 billion. Now, a big chunk of that increase was from mark-to-market changes in investments. They hold the value of stocks changing, plus that improved operating income we just mentioned. There were some small offsets from selling subsidiaries.
They also report non-GAAP net income, right? To smooth things out.
Exactly. And that number was pretty stable year over year, RMB 158.1 billion or US $21.79 billion. Adjusted EBITDA, which is a key measure of their core operating profitability, that grew 5% to RMB 173.1 billion, roughly US $23.85 billion.
So that 5% reflects the revenue growth and efficiency gains, but you mentioned it was offset by investments.
Right. They're clearly investing back into the business, which tempers that core profit growth slightly.
Okay, what about cash? Free cash flow.
Now that's where you see the impact of those investments. For the full year, free cash flow was down significantly, 53% lower year over year, landing at RMB 73.9 billion or about US $10.2 billion.
Wow, 53% drop. Why so steep?
The main reason they give is a big increase in spending on cloud infrastructure, building out those data centers and capabilities.
Okay, so summing up the full year. Revenue up, operating income way up, showing efficiency, reported net income boosted by investments in operations, core profitability growing steadily despite investment, but free cash flow taking a big hit from that infrastructure spend.
That's a good summary. Now let's zoom into the latest quarter, Q4 FY25, the 3 months ending in March. See the most recent trends.
Right. What did that look like?
Revenue for the quarter, RMB 236.5 billion, so US $32.6 billion roughly. That's up 7% year over year. Similar pace to the full year.
And net income for the quarter?
Showed a massive percentage increase, over 1,200%, reaching RMB 12 billion or US $1.65 billion. But, you have to remember the base number from last year's Q4 was quite low, so that makes the percentage look huge.
Right, context matters. What about the non-GAAP figure?
That was up a solid 22% to RMB 29.8 billion, about US $4.1 billion. So that suggests stronger underlying profit growth in the quarter itself. And adjusted EBITDA looked good too, up an impressive 36% to RMB 32.6 billion or US $4.5 billion. Strong operational improvement signs there.
I'm guessing free cash flow followed the annual trend.
You guessed it. Another big drop for the quarter, down 76% year over year to just RMB 3.7 billion or about US $516 million. And again, the report points squarely at heavy investment in cloud infrastructure.
So the Q4 story reinforces the full year. Better operational efficiency, stronger core profits, but that heavy infrastructure investment continues to really weigh on the cash generated.
Exactly.
Maybe we can quickly touch on the individual segments. Where's the action really happening in Q4?
Sure. Taobao and Tmall Group, the core China e-commerce, revenue was up 9%, mostly driven by customer management services, think ads and commissions, which grew 12%. And they're still investing heavily there. User experience, price, service, that 88 VIP membership program.
Which hit 50 million members, you said?
Yeah, over 50 million premium members, double-digit growth, and applying AI tech there too.
Okay, what about international? AEDC.
Strong revenue growth, 22%. And they mentioned focusing on efficiency, which helped narrow the operating loss for the quarter compared to last year. Specifically, AliExpress's choice business is apparently getting more profitable per order.
But for the full year, the international loss actually grew.
It did, yeah. Because of investments in AliExpress and Trendyol, mainly, though Lazada's losses did shrink. So a mixed picture depending on the time frame and platform.
Now, the Cloud Intelligence Group, that seems like a major focus.
Oh, absolutely. Revenue grew 18% in the quarter. Driven by public cloud strength, and get this triple-digit growth in AI-related products for the 7th quarter in a row.
7th, wow. So the demand for their AI on the cloud is really intense.
Seems like it. They're talking about broad industry adoption, success with tools like their AI coding assistant, Lingma. Gartner even recognized them in multiple generative AI areas.
And this ties into the CEO's vision.
Directly. Driving AI plus cloud as a new engine. They're positioning AGI, artificial general intelligence, as a primary goal. The CEO even likened AI to future electricity and cloud as the grid. Big vision stuff.
And the segment's profitability.
Adjusted EBITDA was up 69%, which is huge. Growth and efficiency paying off, though, again, partly offset by investments within the cloud segment itself.
Okay, quickly then, Cainiao Logistics.
Revenue down 12% in Q4, partly because some logistics functions were taken in-house by the e-commerce arms, apparently. But their loss narrowed for the quarter. The full-year adjusted EBITDA was way down, though, partly due to costs related to pulling their IPO last year.
Local services, AMAP, and Ayla.me.
Revenue up 10%. Order growth in both, plus marketing services. And their loss narrowed too, better unit economics.
Digital media, Youku.
Revenue up 12% from movies and Youku ads. And interestingly, that segment actually turned profitable on an adjusted EBITDA basis in the quarter, mainly thanks to Youku.
And finally, all others.
Up 5%. Growth from Freshippo Grocery and Alibaba Health, but offset because they deconsolidated SunArt, the retail chain they sold. Which also explains why their overall employee count dropped significantly. Those SunArt employees aren't counted anymore.
Right. And beyond the operations, they're also returning cash to shareholders. It's a big theme.
How much?
They bought back US $11.9 billion worth of shares in fiscal 2025, reduced the share count by over 5%.
And dividends, too. Yep. The board approved annual and special dividends totaling US $4.6 billion for the year.
Okay, so pulling all these financial threads together for you, the listener, it really shows Alibaba focusing hard on core e-commerce, but making absolutely massive bets on AI and cloud.
Yeah, and that focus is boosting segment growth and efficiency. You see it in operating income and adjusted EBITDA. But those huge investments, especially in cloud, are really hitting the free cash flow right now.
So how did the market react to all this? Q4 numbers specifically.
Well, despite those growth and efficiency stories, the headline revenue and net income numbers were actually slightly below what analysts were expecting.
Oh, and the stock price.
Took an immediate hit. One source mentioned about a 7% drop in the U.S. stock right after the results came out. Short-term reaction.
But what about the longer-term view from analysts?
Overwhelmingly positive, actually, based on the sources we looked at. Most ratings were buy or strong buy.
Any sell ratings?
None mentioned in our sources. Price targets varied, of course, from like the low $110 up to $190, but the general sentiment was bullish.
And there's some technical analysis mentioned too.
Just briefly, noting the stock had been trending up before the earnings dip and outlining some potential price scenarios based on charts. Just another perspective.
Right, so you've got these different lenses, the company's performance and strategy, the market's instant reaction to expectations, and then the analysts looking further out.
Exactly.
Okay, so let's recap this deep dive. We've seen this incredibly intense, diverse competition in e-commerce. Giants, specialists, even Alibaba's own platforms, all jostling, while big trends like mobile, AI, social commerce are changing the whole game.
Yep. Then we dove into the financials, Q4 and the full year 2025. Saw revenue growth, big jumps in operating income and net income, though, with some caveats and strong performance in key areas like cloud and international.
But also those really substantial investments, especially in cloud infrastructure for AI, hitting that free cash flow hard.
Yeah.
It highlights that tension, right, between investing for future growth and managing current profit and cash.
Definitely a balancing act, and we saw the market react a bit cautiously to the latest numbers missing estimates, but analysts remain pretty positive overall for the longer term.
So here's the final thought, the big question maybe for you to chew on. Alibaba has explicitly stated that achieving artificial general intelligence, AGI, is a primary objective. They're backing it with massive spending on AI and cloud.
Positioning it as their new engine, like we said.
Right. So if they succeed or even make significant strides towards AGI, how could that completely reshape not just Alibaba, but this entire global e-commerce and tech landscape we've been talking about? Could it fundamentally change what competition even looks like in this space?